The UK housing market has just delivered a shock that almost nobody saw coming. For months, economists were calmly talking about soft landings, gentle corrections, and modest single-digit declines. The narrative was controlled slowdown, nothing dramatic, nothing dangerous. But what's unfolding right now across Britain tells a completely different story. House prices aren't just dipping, they are falling at a pace that has caught seasoned analysts, lenders, and homeowners completely off guard. And if you own property, plan to buy, or even rent in the UK, what's happening now could reshape everything you thought you understood about British real estate. The latest housing data has sent shockwaves through the market. In just 3 months, average house prices across England have dropped by more than 7%. On the surface, that number might not sound catastrophic, but context is everything. That is the sharpest quarterly fall since the financial crisis of 2008. We are no longer talking about a mild cooldown after years of growth. This is a rapid contraction happening in real time. Estate agents who, just a year ago, were juggling bidding wars and sealed offers are now watching listings sit unsold for months. Properties that once attracted multiple offers above asking price are now seeing price reductions, sometimes repeatedly, with little interest. What makes this even more striking is how confidently the warning signs were dismissed. Only 6 months ago, major banks and property analysts were predicting a manageable decline of 3 to 5% over the entire year. It was framed as healthy, even necessary, a controlled correction that would restore balance. Instead, the market has blown straight past those forecasts. In some areas, prices are already down by double digits, and we are not even at the end of the year. The experts misjudged the speed and scale of the shift, and homeowners are feeling the consequences. So what triggered this sudden downturn? It isn't one single factor. It's a collision of pressures hitting at exactly the wrong time. Interest rates have climbed to levels not seen in more than 15 years. Mortgages that were once secured at 1 or 2% are now being offered at 5, 6, even 7%. For households coming off fixed deals, that means monthly payments jumping by hundreds of pounds overnight. For first-time buyers, it means affordability calculations no longer work. A home that looks cheaper on paper can actually cost more per month because of the higher rate environment. At the same time, the cost of living crisis continues to squeeze families. Energy bills remain elevated, food prices are stubbornly high, and wages have struggled to keep pace with inflation. Disposable income has shrunk. Savings have been depleted. Demand, which is the lifeblood of any housing market, has evaporated. And when demand disappears, prices follow. There is another powerful force accelerating the decline. For years, buy-to-let landlords and property investors played a major role in supporting prices, especially in cities. But tighter regulations, higher taxes on rental income, and rising borrowing costs have made the sector far less attractive. Many landlords are now selling up. That surge of supply is hitting the market at precisely the moment buyer demand is weakest. More homes available, fewer buyers interested. It's a recipe for falling prices, and as prices fall, potential buyers hesitate even more, waiting for a better deal. The cycle feeds itself. Regional differences add another layer of complexity. London, long considered untouchable, is experiencing some of the steepest declines. Properties in zones that were commanding eye-watering premiums 18 months ago are now being discounted heavily. International buyers who once fueled the capital's luxury market have largely stepped back, deterred by economic uncertainty and global instability. In the North and Midlands, the falls are slightly less dramatic, but still painful. A 10% drop in value hits just as hard whether you live in Manchester or Camden. First-time buyers are facing a brutal paradox. Falling house prices should mean improved affordability, but higher mortgage rates cancel out much of that benefit. In many cases, the monthly repayment on a reduced-price home today is higher than it would have been on a more expensive property 2 years ago. Lenders, wary of falling collateral values, have tightened criteria. Deposits need to be larger. Affordability tests are stricter. Young buyers who saved for years are stuck watching the market shift without being able to step in. The government's response so far has been notably muted. Historically, sharp housing downturns have triggered policy intervention, whether through stamp duty adjustments, support schemes, or relief measures for struggling borrowers. This time, there has been little movement. Some argue policymakers may quietly welcome lower prices after years of affordability crisis. Others suggest public finances simply cannot support major intervention. Either way, homeowners dealing with negative equity and rising repayments are not seeing meaningful relief. Commercial property is also under strain. Office spaces in major cities are still grappling with the long-term shift toward hybrid work. Companies are downsizing their office footprints, leaving landlords with declining rental income. Retail property, already weakened by online shopping, faces further pressure as consumer spending tightens. These declines ripple outward, affecting pension funds and investment vehicles heavily exposed to real estate assets. Mortgage holders on variable rates are living in constant uncertainty. Every Bank of England decision carries weight. Even small rate increases translate into higher monthly bills. Meanwhile, hundreds of thousands of households who fixed their mortgages at ultra-low rates in 2020 and 2021 are approaching the end of those deals. The payment shock awaiting many of them is significant. Repossessions remain relatively contained for now, but concern is building that distress could rise if unemployment ticks upward. Developers are already pulling back. New housing projects are being paused or cancelled because falling sale prices erode profitability. Construction sites that were active months ago are quieter today. This slowdown threatens jobs and could worsen the UK's long-standing housing supply shortage. Ironically, today's downturn could sow the seeds for future price pressure once demand eventually recovers. Renters are not benefiting from falling house prices either. Rental costs in many regions continue to climb. As landlords exit the market, rental supply tightens. At the same time, would-be buyers remain in rented accommodation longer. The result is sustained upward pressure on rents. Many tenants find themselves trapped, unable to buy and unable to save due to rising living costs. Negative equity is emerging as a serious concern for those who bought near the market peak. If your property value drops below your outstanding mortgage, selling becomes financially painful. It limits mobility, locks households into existing loans, and creates psychological stress. A home that once symbolized financial security can quickly feel like a burden. Internationally, the UK is not alone in facing housing turbulence. Other countries that experience prolonged periods of ultra-low interest rates are also adjusting to tighter monetary conditions. But the UK's mortgage structure, with shorter fixed terms and greater exposure to rate shifts, means households feel the impact more rapidly than in countries dominated by long-term fixed loans. Where does the market go from here? Forecasts vary widely. Some analysts believe the worst declines may be behind us, with stabilization possible if interest rates plateau. Others warn that deeper corrections could unfold if economic growth weakens or unemployment rises. Housing markets are driven not just by numbers but by sentiment. Right now, confidence is fragile. Fear and caution dominate decision-making. What is clear is that the UK housing market has entered a new phase. The era of near-guaranteed price growth appears to be over, at least for now. Risk has returned. For some buyers with cash and patience, this environment presents opportunity. For many homeowners, it represents stress, uncertainty, and financial strain. The housing market touches almost every part of the economy. When it falters, confidence falters with it. Generational wealth, retirement planning, and economic mobility are all tied to property ownership in Britain. The coming months will be critical. Whether this becomes a painful but temporary correction or a prolonged slump depends on interest rates, policy decisions, and the resilience of households. One thing is certain, the assumptions that guided the market for more than a decade have been shattered. The UK property story is being rewritten in real time. And for millions of families, the outcome of this chapter will shape their financial future for years to come.